takes back some of all that liquidity they've put in the market. You argue you really can't prepare for that in terms of timing it exactly. So you diversify now, right? That's what bondholders should be doing?
That's right. We think that bondholders, they face many challenges in today's market because interest rates are at all-time record lows, not only here in the United States but across the globe. But we think that one of the most effective ways to counter that is to look beyond the Treasury market, beyond cash investments, and get exposure to some other areas that have some attractive yield and some attractive return potential going forward. But to time the entry into that, we think is quite difficult. So I think an investor is best served by creating a diversified portfolio of many of these areas of the market that we think remain attractive in fixed income, do offer more yield than what's available in cash in the Treasury market. And with that, they will really, we think, over a 12 to 24-month horizon, be really pleased with the outcome of that portfolio.
So one area you like is foreign bonds. There's a couple of countries specifically you like. Which are they and why?
So the countries that we like, first of all, we think investors should get exposure to non-U.S. markets. It's over 60% of the global fixed income market is non-U.S., so it's a big playing field, and there are lots of opportunities. Where we like to go is to countries where there are solid balance sheets, so low levels of debt, low budget deficits, and where there's decent growth. So the opposite of that would be Europe, for example, where there's high debt, low growth. We think you want to get exposure to higher growing areas. That leads you to countries like Mexico, like Korea, Australia, Canada, where you get exposure to the better growth with better financials, better balance sheet strength in those countries.
Do you like that in local currency in terms of the bonds?
In many cases we do. So we go country by country. So where we can find a higher yielding country that we think has decent growth and the central bank is not looking to depreciate the currency, there we do like to get it in local currency. In other cases, we will hedge the currency risk and just get exposure to that bond market.
You also like investment-grade corporates. Probably people that never thought about this suddenly woke up when they saw Apple decided to issue bonds. What do you think of Apple's offering? Is that debt you would hold? And when do you see that move into investment corporates losing some steam?
Sure. We think that investment-grade corporates are attractive, but primarily in the financial sector. So with the Apple securities, for example, we think they're fair value, but we think there are better opportunities in the financial area of the market. So the JP Morgans, the Bank Americas of the world, Goldman Sachs, where we see really strengthening balance sheets by the financial sector. Whereas in the non-financial sector, of which Apple represents that, there we see spreads or risk premiums that have really compressed quite a bit. So the relative value is not nearly as attractive when you look at the non-financial sector of investment-grade credit.